Hi guys, can you hear me clearly? पानी की बोतल चाहिए यार, पानी की बोतल मिलेगी? ऐसे पेन की आवाज मत करना, टक टक। हम्म हम्म तो ये कह रहा हूँ यार, तुम लाइब्रेरी में जाके पढ़ लो ना। बात सुनो, लाइब्रेरी में जाके पढ़ लो। नहीं नहीं, रिकॉर्डिंग बनानी है मेरे को। 2.5 घंटे वो रिकॉर्ड कर, वो वैसे नॉर्मल। हाँ, शोर मत करना।
Hi guys, can all of you hear me? Sana, Sunil, Karishma. So we'll start the session now. Are you able to see my screen? Do you see the slide titled Overview of Equity Securities? Okay. Yellow. No, this guy. So we'll start with reading number 49 of the CFA Level 1 curriculum that will give us a detailed overview of the various types of equity securities. So when we generally say equity security or an equity shareholding, we are referring to the common shareholders. So common shareholders have a residual claim on the firm's assets and they govern the corporation, that is, they are the owners of their company who govern their corporation through their voting rights. So a residual claim implies that after claims of the other stakeholders, that is debt, preferred equity, employees, any litigation, etc., has all been paid off, whatever is remaining belongs to the common shareholders. Common shareholders are entitled to receive dividends. These dividends, however, are dependent on the profits that the company makes and hence can be variable in nature. The firm has no legal obligation to pay dividends. However, as we'll see in the review on valuation, dividend paying firms generally will be valued highly and would be preferred by investors. So companies do tend to pay dividends under many circumstances, and shareholders receive dividends as cash inflows from the equity securities that they own. So equity essentially implies ownership in the form of common shareholding, which has a claim to the residual assets of the firm. So common shareholders vote for the board of directors. Board of directors represent the shareholders' interests to the management. So the board of the directors are the link between the shareholders and the management. So the management is generally referred to as an agent of the principal or of the shareholder. So the management of a company works for the shareholders in the interests of the shareholders, and they get salary and performance linked bonuses, etc. The board of directors represent the shareholders' interests to the management, that is the CEO and the other top staff. So the shareholders elect the board of directors, and it's a process of voting. Proxy voting is generally allowed, that is, if a shareholder is not present physically himself, then a representative or through some other manner the voting can be done. Now, in a statutory voting system, each share equals to one vote for election of each member of board of directors. So if you have 100 shares, that means you have 100 votes. So each share equals 1 vote. However, the problem in a statutory voting system is that you can vote for only one person. So if there are 5 board members, and let's assume there are 10 candidates, then even though I own 80% of the company, I can influence only 1 out of the 5 board seats. That is, each of my shares is entitled to be 1 vote. However, I can vote for only one person. So even though I own 80% of the company, I can influence only 20% of the board seats. The remaining 5 will be chosen by the other shareholders. In a cumulating voting system, on the other hand, it's the same. Each share equals 1 vote. However, the shareholders can allocate their shares to 1 or more candidates. That is, if I have 80%, तुमने इंटरनेट चलाया हुआ है क्या? इंटरनेट यूज कर रही हो क्या? मेरा इंटरनेट बंद हो जा रहा है. रन पे चली जाओ यार. रन पे चली जाओ. मैं वैसे ही कर रहा हूँ. शाम को जाती हो तुम. शाम हो गई है अब. जाके सो जाना फिर टाइम पे.
किस चीज़ के लिए? इंटरनेट बंद हो गया मेरा. एक बार इंटरनेट कनेक्ट करके देखना तुम्हारा हो रहा है. हो रहा है. चल रहा है. हाँ चल रहा है. I'm sorry, guys. Some trouble with my internet. What is the last you heard? What is the last line you heard? So callable common shares are like common shares in that they have the same voting rights and they're also entitled to the variable dividends. However, the downside of callable common shares is that the firm can call these shares back from the investor, or in other words, the firm can repurchase these shares from the investor or the shareholder at a pre-decided price.
So let's say the firm issued a callable common share for $50. However, the share is callable at a price of $100. So in such a case, for all practical purposes, the upside of these shareholders is limited to $100 because if the stock price goes above $100, then the firm has the right to buy these shares back from the shareholder at $100 and pay him $100. So the upside, remember, of callable common shares is limited, hence they are not as lucrative or as preferred as regular common shares. The reverse is the case with puttable common shares. So in callable common shares, the right is with the firm. In puttable common shares, the right is with the investor. So in this case, the investor or the shareholder can sell the shares back to the firm at a pre-decided price. So let's assume the shares were issued at $100 and let's assume that they are puttable at $50. So in such a case, the downside of the investor is now limited because he purchased at 100. The upside is all his. However, on the downside, if the share goes below $50, the shareholder can still sell it back to the company for $50. Hence, puttable common shares are more valuable than regular common shares. They give an additional right to the investor or to the shareholder. Callable common shares give an additional right to the firm and hence are less preferred to regular common shares. Another type of equity is referred to as preferred equity or preferred stock. So preferred stock typically does not mature. So it's like debt in many ways, or it's like a fixed income security in many ways. However, it does not have a maturity date like a regular fixed income security. So if a $100 preferred stock is been issued with a 10% preferred dividend, then this $10 will continue, or the firm will generally pay the $10. However, there is no pre-decided date at which this $100 will be redeemed or at which the preferred stock will be extinguished. So this $10 will continue for the life that the preferred stock is outstanding. There is no date at which the $100 principal will be returned. So the interest or the dividend will be continuously paid. Preferred stockholders generally do not have voting rights, and the dividends are fixed in amount but are not a contractual obligation of the firm. So in case the profits are not enough, then first the debt holders will be paid, and only if money is remaining, any funds or money to preferred stockholders will be paid. So preferred stockholders will be paid before common shareholders or before common equity, but after fixed income instruments or after paying debt if any money is remaining. Cumulative preferred shares require that any dividends that were missed in the past should be paid before common shareholder received any dividends. So let's assume I missed this $10 payment in 1 year. So if I miss it, then in case of a cumulative preferred share, in the next year I'll have to pay 10 plus 10, $20 before any payout can be made to the common shareholders. In non-cumulative preferred shares, if a payment gets missed because the profits were not sufficient, then the payment gets missed. There is no obligation of paying double the amount next year or any such thing. Participating preferred shares receive extra dividends if the firm profits exceed a pre-specified level and a value greater than the par value if the firm is liquidated. So they participate in the profits in some manner. They're still not like common shareholders who get all residual value,
but they participate in the profits to some extent is what you can assume. Convertible preferred stock, as we'll see in more detail in financial reporting, can be converted to common stock at a pre-specified conversion ratio. So we'll do a couple of examples of this in financial reporting. If you've already done that class, then you would have seen a few examples of convertible preferred stock. So these can be converted to common stock. Some companies' equity shares are divided into different classes. That is, a class A and class B common shares. So different classes of common equity generally tend to have different voting rights. So a class A may not be allowed to vote, whereas class B is allowed to vote for the board of directors, or class A is not allowed to vote for significant M&A transactions, something like that. So there is some difference in voting rights and some difference in the priority in liquidation between class A and class B shares. Hence the value at which the two will be trading will also be different corresponding to these rights. Compared to publicly traded equity, private equity firms have lower reporting costs because they are not listed on an exchange, so they don't have to comply with all the rules and regulations that the regulators impose on publicly listed companies. They have a greater ability to focus on the long-term prospects and potentially greater return once the firm goes public. So if you invest in a private company, your risk will be higher because the reporting and the governance will not be as strong as a public company. However, the long-term prospects and the returns can be better because they are not judged on a day-in, day-out basis by investors and analysts, etc. So they can focus more on the long term as compared to public traded equity or public firms. However, private equity investments do tend to be illiquid. The financial disclosures may be limited and the corporate governance may be weaker as compared to publicly listed firms. Now the returns from equity investments come from dividends, that is the cash outflows or the residual income that is paid to the shareholders. It could be capital gains, that is stock price appreciation, or it could be losses from a decline in share price. Any foreign exchange gains or losses if you've invested in the shares of a foreign company, and the compounding of reinvested dividends, that is the earnings that are not paid out to shareholders, rather they are reinvested into the firm, has traditionally been an important part of an equity investor's long-term return and the long-term capital appreciation. So stock prices go up because firms reinvest the funds that they have earned and generate further return on those reinvested funds, resulting in higher value for the company and for the shareholders. Preferred stock is less risky, as we studied, because preferred stock pays a known fixed dividend. These stockholders must receive dividends before common stock dividends are paid. So preferred stocks have a claim equal to the par value if the firm is liquidated. So in the case of bankruptcy or any form of liquidation of the firm, the par value of preferred stock will have to be returned first before any payout can be made to equity shareholders. Puttable shares are least risky and callable shares are most risky, as we discussed. Cumulative preferred shares are less risky than non-cumulative preferred shares, as any dividends missed must be paid before a common stock dividend can be paid. This also we discussed. Now we will refer to a market as integrated if capital flows freely. That is, we can buy and sell any security or any asset in that country, take our money out into another country, and so if funds can easily move into the market and funds can easily move out of that market into another market or another country, then we will call the market as integrated. So an integrated market
it's normally not a problem. You can easily invest and repatriate your returns or cash in your investment whenever you like. In markets that are not fully integrated, it becomes a little difficult, so you have to find out ways and means of acquiring a stake in companies listed in these non-integrated markets. So with special regulations, many a times direct investing is allowed. So direct investing means going into that country and buying the assets. So buying foreign securities in foreign markets would be an example of direct investing. Depository receipts are another way of taking a stake in a foreign market. However, through depository receipts, what the foreign company does is that the foreign company gets listed on the local exchange. So a depository receipt represents ownership of foreign firms but are traded in the local currency. So if I am an India-based company, for instance, and I feel that there will be a lot of investor interest in my company in the US, then I can go and get my stock listed on the US exchange. Of course, I will have to comply with all the US regulations and disclosures, but what this enables is that the US investor doesn't have to go to India to buy my share. He can simply purchase the American Depository Receipt, also referred to as ADR, and get a ownership in my company. GDRs refer to Global Depository Receipts. So this is when companies are listed in other countries except the US. So if a Mexico-based company or a Morocco-based company lists in the US, then that will be referred to an American Depository Receipt. If that company lists guys, just wait for 10 minutes, please.
I'm sorry. Um, Guys, 1 minute, okay? Just give me 1 minute. I'm sorry. Guys, I'm sorry. I actually just moved from Mumbai to Hong Kong, and just some setting up issues in my house. So I don't want to cancel the session because we're anyways lagging a little bit behind. So just give me 1 minute, okay? We'll be back on track. So if an Indian firm lists in Great Britain, for instance, then the securities can be purchased in pounds directly from the London Stock Exchange. So those securities will be referred to as GDRs, or Global Depository Receipts. So G stands for global. If it lists it in any other country, in Spain, in France, in Germany, then it will be a Global Depository Receipt. Only for US there is a special name, or we call it American Depository Receipt. So it's the shares of a foreign company. However, they are listed on your local exchange. So a US investor can buy them in US dollars, a British investor can buy them in pounds, so on and so forth. Investors who buy foreign stock directly on foreign stock exchange receive a return denominated in the foreign currency. They must abide by the foreign stock exchange's regulations and procedures, and may at times be faced with less liquidity and less transparency than is available in their home markets or domestic markets. So if a US investor buys in India, then first of all the Indian currency movement affects him, then Indian regulations and procedures is what he has to comply with. There may be less transparency as compared to the companies listed in the US that have much stringent regulations. So to avoid these disadvantages, investors would prefer purchasing depository receipts of the foreign stock that trade on their domestic exchange. So GDRs, or Global Depository Receipts, are issued outside the United States and outside the issuer's home country. American Depository Receipts are denominated in US dollars and are traded on US exchanges. So they are just a special name for US listed securities of foreign companies. And another term called Global Registered Shares are again common shares of a firm that trade in different currencies on stock exchanges throughout the world. So these are globally registered shares. So these shares can trade in multiple exchanges in the world. So for American Depository Receipts, there are generally 3 levels. So
if it's an OTC registration. So please note, if I am an Indian company, then for me to get an ADR registered or for me to be listed in the US, it's going to be expensive. I will have to follow all their norms. I will have to follow accounting by the US standards. I will have to meet their regulations, so on and so forth. So for level 1 listing, the costs are normally not very high. However, you will not be allowed to access the exchanges in the US. So your shares can only be traded over the counter. You will require a registration, but you will not be able to raise fresh capital in the United States, and your compliance costs, listing expenses, etc. are generally low. So if you just want a presence in the US, you don't really need money, you don't really need new capital, etc. Then a level 1 listing is what an Indian company or a foreign company can go for. A level 2 listed ADR will be traded like any other US stock. So if an Indian company gets listed in the level 2 route, then it will be traded on the NYSE, NASDAQ and the Amex. Registration will be required. You still can't raise capital in the United States, and listing expenses and compliance costs will be high. For a level 3 ADR, again, basically regulations will be even more stringent, and this kind of a company can even directly raise new capital from US investors directly from the US. Rule 144A applies to private companies, so no registration is required, and you can raise capital, but again you can't go to retail investors. You can only go to qualified institutional investors, etc. So this is also a common route for companies listed abroad to raise money in the US. Now, very importantly, the book value of common equity is defined as the difference between the financial statement value, very important. So it is just the reported value of the firm's assets minus the reported value of the firm's liabilities. Positive retained earnings will increase the book value of equity, and negative retained earnings or losses will decrease the book value of equity. So book values today reflect the firm's past operating and financing choices. So a firm has assets, that will be his plant and machinery, some cash on books, some accounts receivable, and it will have some liabilities. There will be long-term liabilities like debt that has to be paid. There will be some current liabilities. So whatever is remaining of the assets after paying off these liabilities is referred to as equity or book value. So book value is the reported, but please note that balance sheet items are at historical cost. So plant and machinery, cash, accounts receivables will all be at historical cost, and so will the liabilities. The difference between the assets and the liabilities gives you the common shareholding or common equity, also referred to as the book value of equity. Now, the book value of equity will often differ from the market value of equity, which is simply the share price multiplied by the number of shares outstanding. So while book value is a accumulation of past activities and past financing choices, so depending on how much debt you have chosen to keep, depending on what assets you have purchased, will define your current book value of equity. The market value, on the other hand, reflects expectations about future cash flows and future accretion to this book. So the market value of equity can also be written or can also be thought of as the perceived fair value of equity. Now, this is how the market perceives the fair value of the book to be, or the fair value of the equity to be. So even though assets minus liabilities is so much, since the balance sheet represents historical values, the current value of the equity may be different from the book value. So the market value is the fair value of the book, or the fair value of the equity, or this is the price that needs to be paid to acquire the company today or to buy out the company today. The market value reflects investors' expectations about the timing, amount, and risk of the firm's future cash flows. So book value of equity is defined as the firm's assets minus the firm's liability. Market value is the outstanding number of shares multiplied by the stock price. It reflects expectations about future performance. Sometimes market value can be less than book value also. If expectation is that future performance will be very bad and the company's assets will reduce in value and liabilities will go up in value, the market value can even be lower than the book value. If the expectation is that the company's assets will grow and the company's liabilities will reduce, then the market value will be higher than the current book value. The market value and book value are seldom equal. They're normally very different. A very important metric that every investor or every shareholder is very interested in is referred to as the return on equity, or the ROE. So the return on equity is defined as the net income upon the average book value Now, why this calculation is very important is because as a common equity holder, net income is what he receives, or net income is actually the income of the common shareholder. After paying off debt, that is after paying off interest expense, after paying off employees, raw materials, etc., this is the amount that is remaining for shareholders. But how much have shareholders invested in the business? Or what is the shareholders' claim on the business? It is the book value, because the assets, after paying all the liabilities, belongs to whom? Belongs to the common shareholders. So this is the investment that the shareholders have in this company. And on this investment, the net income is the return that they are getting every year. So an investor, when deciding whether he should keep his money in the stock or keep his money invested in this company, or at what valuation he should invest the money in this company, would always be interested in evaluating the return on equity. That is, what is the income that the firm is generating on the investment that has been made by equity shareholders. Because today the firm can sell its assets, sell its liabilities, and return this equity back. However, if the firm is keeping it invested, then there should be a commensurate net income also that should be produced. So the ROE is calculated as the net income divided by the average book value. And a lot of times the ROE is calculated as the net income divided by the beginning of year book value. So both methods are correct, both conventions are used. Just make sure that when you're comparing, if you're using the beginning book value for one company, use the beginning book value for the other company also. So net income upon the beginning book value, or net income upon the average book value, is the return on equity. Average simply means the beginning value of the book value and the current value of the book value divided by 2. So we'll do an example and understand this. Given the figures below for share industries, calculate the return on average equity for 2005 and the total market value of equity. The book value per share and the price to book ratio at the end of 2005. So the first calculation is the return on average equity. So return on average equity will be calculated as the net income upon the average book value. So the net income in 2005 is given to be 3645 divided by the average book value. So the average book value is the total stockholders' equity. So this will be 19402, that is the current book value, plus 16141, that is the book value at the beginning of the period, divided by 2. So this will be the return on adjusted equity. The market value of equity would be the stock price multiplied by the number of shares outstanding. So this will give us the market value of equity. The book value per share at the end of 2005 will simply be the total stockholders equity divided by the total number of shares. So it will be 19402 divided by 3895. This will be the book value per share. And the price to book ratio at the end of 2005 can be calculated as the price per share divided by the book value per share. So we have the price per share, that is 17.1, divided by the book value per share, that will come from the calculation that we just did. So this is how we can calculate the metrics that we need. So please verify. The return on average equity will come out to be 20.51%. The market value will come out to be 66604. Book value per share would be about $5. And the price to book ratio would be 17.1 divided by 5, that is approximately 3.433. Now please note that we'll study the price to book ratio in more detail when we study ratio analysis and when we study equity valuation. But it would be important to understand that the price to book ratio essentially tells us how different is the market value of equity from the book value of equity. So if the price to book ratio is 3.433, for instance, then what this implies is that the current market price is 3.4 times, or market is willing to give 3.4 times the reported book value of equity. So the market is expecting future cash flows and future profits to be good, such that assets will go up, cash will go up, and equity will go up in the future. In a company where expectations are good, the market price will be much higher than the book value, or this multiple will be high. In companies where expectations are poor, the market value of equity will be lower, or this multiple will be lower. Now, the book value of equity essentially goes up to the extent of the retained earnings. So what is book value? It is the equity. If in a particular year I have a net income and I pay it all out as dividends, then my book value of equity won't change. To the extent that I retain the earnings, the book value will keep going up. So if the market is expecting that high income will be earned and it will be reinvested in the business. So if I reinvest in the business, I can buy more assets. I can generate more income in the future. Then the market will be willing to pay a high price to book ratio, or the market price per share, which in this case is 17.1, will be much higher than the book value per share. So price to book multiple is also an important valuation metric that we will see in the sessions to come. So the accounting return on equity is calculated as the firm's net income divided by the book value of common equity, as we just did in the example. ROE measures whether the management is generating a return on common equity, but is affected by the firm's accounting methods. So the net income, depending on the depreciation policies, depending on various accounting policies, will be impacted. So even the ROE can be impacted by the accounting methods and may differ from firm to firm depending on the accounting method. The firm's cost of equity is the minimum rate of return that investors in the firm's equity require. So investors' required rates of return are reflected in the market price of the firm's share. So the ROE should ideally be higher than the cost of equity. So the return that the net income that the company is generating depending on the equity should ideally be higher than the cost of equity. If that is the case, then the firm will be valued highly, or the price to book multiple will be high. If the ROE is much higher than the minimum required return, then the price to book multiple will be even higher. If the ROE is much lower than the cost of equity, then the price to book multiple or the market price will not be very high. So that was about the reading number 49 that gave us an overview of equity securities. Thanks a lot, and we'll continue the discussion on equity in the coming sessions. So we'll start with reading 51 now, okay? Equity valuation we'll start with first. D.
मैंने उसको बोला थोड़ा अच्छे से प्रेस करने के लिए शॉर्ट्स में, शायद थोड़ा ज़्यादा टाइम लगाएगी। मैंने उसको बोला कि मेरे को अच्छे से चाहिए प्रेस। Reading number 51 of the level 1 curriculum will give us an introduction to the concepts and basic tools of equity valuation. Please note that equity valuation will be dealt with in a lot more detail at level 2 and forms a major chunk of the level 2 curriculum. However, it is important to understand the basic concepts and the methods that we use to finally arrive at the fair value of a stock or the fair value of equity. So we'll go through the brief concepts and try to understand the basics. So the intrinsic value of a company or the fundamental value of a company is defined as the rational value that investors would place on the asset if they had full knowledge of the asset's characteristics. So intrinsic value is essentially the price that you would be willing to pay for something, or that the price that you would be willing to pay for the equity or the debt of a particular company, given that you understand all characteristics, cash flows, governance, and other components of the firm. Analysts use valuation models to determine the intrinsic value and to compare it with the stock's market price. And they then determine that whether the stock is overvalued, undervalued, or fairly valued. So if the stock's market price is greater than the intrinsic value, then we will say that the stock is overvalued. If the stock's market price is lesser than the intrinsic value, that is the fair value, it's trading cheap, then we will say the stock is undervalued. If it is equal to the intrinsic value, then we say the stock is fairly valued. Now, how do we derive the intrinsic value, or how do we determine the fundamental value, is essentially what we're going to try to study in this review. So there are various methods that we will study to compute the intrinsic value of the stock. The first category of methods is referred to as the DCF based methods, or discounted cash flow or present value models, wherein we'll project the cash flows and discount them back to derive the intrinsic value. So there are two broad models that we'll study. One is the dividend discount model, and the second is the free cash flow discount model. We can use multiplier models, or also referred to as market multiple models, where we'll see the ratio of the stock price to earnings, the stock price to sales, the stock price to book value, or the stock price to cash flow, and compare it with other companies in the sector. And we will then argue that similar companies or similar goods should have similar price and try to derive the intrinsic value. We can similarly use EV to EBITDA ratio also, or EV to revenue ratio also, as we'll see. Third category of models is referred to as asset-based models, wherein the intrinsic value is calculated as the fair value of the assets minus the fair value of the liabilities. Please remember, asset minus liabilities was the book value. But if I do the fair value of the assets minus the fair value of the liabilities, it should give me the market value, or it should give me the intrinsic value of the stock. So moving on to the first model, that is the dividend discount model, or so-called the DDM. The most general form is to simply project the expected dividends that the stock will pay until infinity and then discount them back to compute the value of equity. Please note this is theoretically a correct model, a well justifiable model, because eventually in the long run dividends is what equity holders are entitled to and what they receive from an asset. So if the asset doesn't pay any dividends ever, then essentially shareholders will not get any return back. Dividends may come in the future, but at some point dividends are needed if the equity holder has to realize a cash return. So if you project the dividends out until infinity and then discount it back, we can derive the fair value of the stock, or that will be the intrinsic value of the stock. So we'll start by understanding the 1-year holding period DDM that can be calculated as the next year's dividend plus the year-end price discounted back. So calculate the value of a stock that paid $1 dividend last year if the next year's dividend will be 5% higher and the stock will sell for $13.45 at year end. The required return is 13.2%. Now please note that the last year's dividend does not matter. That has already been received and used, and it's not going to be a part of the future valuation of the stock. What we are interested in is what dividends the stock is able to pay us in the future. So if it paid a $1 dividend last year, that is at t equal to 0. Please note this dividend does not matter. What matters is the dividends that will come henceforth, t equal to 1, t equal to 2, so on and so forth. So at t equal to 1, the expected dividend is 5% higher, that is 1 into 1.05. And the stock we are given will be able to be sold at $13.45 at year end. So if we hold this stock for 1 year, the total cash that we will get from this stock at the end of the year would be $1.05 of dividend plus 13.45 is what we will be able to sell it for. The value of this stock today, that is at t equal to 0, will simply be the discounted back value. The required rate of return is given to be 13.2%. So the discounted back value would be this upon 1.132, and that will be the value using a 1-year holding period dividend discount model. So the total cash flows, however, the cash flows are coming at the end of the year. So how much will we be willing to pay for these cash flows today? We need a return of 13.2%. So if we pay a value discounted back by 13.2%, then essentially we will get a 13.2% return over the 1-year period if we pay a price equal to $11.88. So 0.93 is the present value of the dividend. 11.88, my apologies, is the present value of the year-end price. So the current value is $12.81. So if we pay $12.81, then essentially over the year we are expected to make a return of 13.2%. Similarly, we can value using a 2-year holding period. So a stock recently paid a dividend of $1, which is expected to grow at 5% per year. The required rate of return is 13.2%. Calculate the value of the stock assuming that it will be priced at $14.12 2 years from now. So once again we'll draw the timeline. At t equal to 0, it was a $1 dividend, it doesn't matter. T equal to 1, the dividend will be 1 into 1.05. At t equal to 2, the dividend will be 1 into 1.05 to the power 2, so on and so forth. The dividend will keep growing. At the end of 2 years, we will also be able to sell the stock for $14.12. So again, to calculate the value of these cash flows today, or how much should we pay for the stock today, that is at t equal to 0, such that we make a return of 13.2%, simply discount the first cash flow by 13.2%. The second cash flow will be discounted 2 years back, so divided by 1.132 squared, and this is the value that we would be willing to pay for the stock today. This is a 2-year holding period DDM. So we can do the calculation and verify that the stock price will come out to be $12.81 again using the 2-period dividend discount model. Now, many a times, a firm may not be willing to pay a very high dividend or may not be paying a dividend at all because the growth opportunities may be very good and the firm is reinvesting all the money for sustainable growth in the future because the opportunity is quite nice. So for such firms, it is difficult to project dividends because of the continuous reinvestment. So what we can do for such companies is that instead of discounting the dividends, that is projecting and discounting back the dividends, we can project the free cash flow to equity and try and discount it back to compute the present value of the firm or to compute the value of the equity. So the free cash flow to equity, as we studied in the review on financial reporting and analysis, if you haven't yet watched that video, you can watch the video and then confirm this. So we'll study free cash flow to equity in detail in financial reporting. Is the cash flow available to equity holders? It may be paid out as dividends or may not have been paid as dividends, but this is the cash that is available to equity holders, may or may not be paid as dividends. Once again, it is the cash available to equity shareholders. So calculated as the net income plus the depreciation, that is a non-cash expense, minus increase in working capital, minus any capital expenditures or fixed capital investment that the company has to make, so all those cash flows, minus any return of debt or principal payments on the debt, plus any new debt that has been issued or new money that has come in, is the net cash available to equity shareholders. So the free cash flow to equity can also be discounted back in a very similar manner. Just like we discounted back dividends, we can also discount back free cash flow to equity to compute the value of the equity. The same formula can also be written as the cash flow from operations minus the capital expenditures or the fixed capital investment plus the net borrowing, that is the new issuances minus the debt principal payments. The discount rate that we were using as 13.2% in the previous questions can be calculated as the risk-free rate plus beta times expected return on the market minus the risk-free rate. So this is termed as the market risk premium. And beta is a measure of how risky the stock is or how risky a particular equity is. We will prove this formula and study in more detail when we study portfolio management. For now, you can just remember it, just like you remembered in corporate finance. This is the same model as the capital asset pricing model, or CAPM. That is, the cost of equity is RF plus beta times the market risk premium, that is the expected return on the market minus the risk-free rate. We can value preferred stock just like we valued a fixed income security. So we studied that the preferred stock pays a fixed dividend until infinity. So it pays a fixed dividend. There is no date of maturity, or there is no known pre-decided date of maturity. So the fixed dividend will keep coming till infinity. So we can discount it back at the cost of preferred stock to derive the value of the preferred stock. So we'll prove very soon that these dividends don't grow and this value will come out to be equal to the preferred dividend upon the cost of the preferred equity. So if a company's $150 par preferred stock pays a $7.5 annual dividend and has a required rate of return of 9%, then the value of the preferred stock can be calculated as the dollar dividend upon the cost of the preferred stock or the required return on the preferred stock, that is 9% of 0.09, which will come out to be $83.33. So if a company is promising to pay me $7.5, then to buy that preferred equity, I would be willing to pay $83.33. That is what would ensure that I make an annualized return of 9%. We now move on to arguably the most important derivation of the review on equity valuation. So this is called the Gordon growth model. This is also a dividend discount model. But with certain assumptions. So in the Gordon growth model, it is assumed that the dividend, that is the last year's dividend, would continue to grow at a constant rate of G. So G is the constant growth rate at which dividends will grow up till infinity. So every year the dividend will keep growing at the rate of G. KE is the cost of equity. And we are asked to derive the intrinsic value of the equity or the present value of these dividends, that is the price that we would be willing to pay for the stock today. So at t equal to 0, if we receive a dividend of D naught and the dividend grows at the rate of G, then at t equal to 1 we will receive D naught into 1 plus G. At t equal to 2 we would receive D naught into 1 plus G to the power 2, so on and so forth until infinity. So at t equal to infinity we would receive D naught into 1 plus GC to the power infinity. The cash flow at the end of year 1 would be discounted back by 1 plus KE. Cash flow at the end of year 2 would be discounted back by 1 plus KE to the power 2. At the end of year 3 we would get 1 plus KE to the power 3, so on and so forth until infinity. At t equal to infinity we will receive a cash flow equal to D naught into 1 plus GC to the power infinity upon 1 plus KE to the power infinity. That will be the present value. Now this is the intrinsic value of the stock that is paying us dividends till infinity. Please note that this series is called a geometric progression. A geometric progression is a series in which each term is the same as the previous term multiplied by a common ratio. That's what a geometric progression is. So each term is the same as the previous term multiplied by a common ratio.
So is this series a geometric progression? And if yes, what is the common ratio? So in this series, each term is the same as the previous term multiplied by a common ratio equal to 1 plus g upon 1 plus ke. Now it can very easily be proved, and you've all studied this at 9th or 10th grade in school, that the sum of a geometric progression till infinity, the sum of a geometric progression till infinity is given as the first term divided by 1 minus the common ratio. The first term in this case is d naught into 1 plus g, that is the dividend at the end of year 1, or the dividend in the coming year you can say, upon 1 plus ke. This is the first term, upon 1 minus the common ratio. The common ratio, as we've derived, is nothing but 1 plus g upon 1 plus ke. So if we simplify this, 1 plus ke would be common in the denominator. This would become 1 plus ke minus 1 plus g. 1 plus ke would get cancelled, and this would be d naught into 1 plus g divided by ke minus g. Please note the 1 will also get cancelled. Or it can be written as d1, that is the next year's dividend, or the dividend at t equal to 1, and that is the dividend in the end of the coming year, upon ke minus g, that is the present value or the intrinsic value of the stock. The assumptions of the Gordon growth model: first, it assumes that dividends are the appropriate measure of shareholder wealth. This is generally true for minority shareholders. So if you own, let's say, just about 100 shares in a company, or let's say a 0.1% of a company, then you don't have a say in the management, you don't have a say in the cash flows, how they will be diverted, the investments that will be made, the capex, etc. So a minority shareholder is pretty much dependent on the majority shareholders to declare a dividend and give the money back. So if you're taking a minority shareholder's perspective, then the Gordon growth model, or a dividend discount model for that matter, may be a good approach to valuing the stock, because a minority shareholder is dependent on the dividends for his return. It is assumed that the dividends will grow at a constant growth rate of g till infinity. So that rate has to be known, and slight fluctuations in this rate can cause big fluctuations in the value. The required rate of return on the stock, KE, is also never expected to change. So in a way, interest rates, risk profile is expected to remain constant. If any of these assumptions is not met, then the model will not be appropriate. However, assuming that we can assume these things, then we can use the Gordon growth model to value the stock as d1 upon ke minus g. Please note, another constraint is that ke must be greater than g. So the cost of equity must be greater than g, otherwise this term will become negative and you'll get a negative stock value. So generally speaking, this model can be used for mature dividend paying companies. That is, companies where growth rates have moderated to a constant level and they will now pretty much grow in line with the GDP, and the cost of equity is higher than the growth rate. It's a dividend paying company. So generally for mature stage companies, a Gordon growth model can be used, and for companies that are younger in their business cycle or in their life cycle, we may have to use a two-stage or three-stage model. So in a two-stage model, what we do is that there is one stage of high growth, which is explicitly forecasted and discounted back. And then we assume that the company will become mature after a point in time and then apply the Gordon growth model. Similarly, in a three-stage model, we assume an initial period of very high growth, then a second period of moderate growth, and then eventually we say that the company will mature and there will be a constant growth rate, and then apply the Gordon growth model. So this is normally the last stage of a multi-stage model, or it can be used to value mature companies that are paying dividends. Calculate the value of a stock that paid a $3 dividend last year if dividends are expected to grow at 8% forever and the required return on equity is 15%. So please note, again, last year's dividend doesn't matter. Even if dividends are growing at a constant rate of 8%, what we are interested in is D1, that is the dividend at t equal to 1. And then we discount it back to bring the value at t equal to 0, or the present value or the intrinsic value, as d1 upon ke minus g. So first let's estimate d1. d1 is $3. So it paid $3 last year, so 3 into 1.08 is d1. Cost of equity is given to be 15%, and the growth rate or G is given to be 8%. So it will be 3 into 1.08 divided by 0.15 minus 0.08, that is $46.28. So that is an application of the Gordon growth model. Using the data from the previous example, calculate how much of the estimated stock value is due to dividend growth. So we'll go back. In the same question, we derive the value as $46.28. So please note that some part of the value is coming from the sustained sales that the company is doing right now. And a part is coming because those sales and the income will grow in the future as well. So the question asks, what part of this value is coming from current dividend and what part of the value is coming from dividend growth? So please note that if we assume that there is no growth, that is the required return on equity is 15% and the dividend does not grow. So basically this $3 continues forever. What will be the value of the stock? The value will be simply D1 upon KE. That is, it will simply be 3 divided by 0.15. Please note G is 0. This is how we can prove the preferred dividend model as well. Remember, the preferred dividend valuation was DP upon KP. It's a similar proof as the Gordon growth model, only in D1 upon KE minus G, this G is now 0, so it will just be D1 upon KE or DP upon KP because the preferred dividend or a constant dividend does not grow. So even if this company had a constant $3 dividend that did not grow, the stock price would have had a value equal to 3 upon 0.15, that is equal to $20. However, we've derived that the total stock price or the total value is about $46.28. So can we say that $20 is coming from current dividend and the remaining $26.28 is coming from growth opportunities or growth in this dividend? Even if the stock didn't grow, there would have been a value of $20. The 26.28 is also called PVGO, or the present value of growth opportunities. Please note in the explanation he assumes 3.24 to remain constant, so you can skip the explanation. What we've done is more correct, assuming that this $3 doesn't grow at all. So just to refresh and wind up the Gordon growth model, the value of the stock is given as D1 upon KE minus G. So as the difference between KE and G widens, the denominator will become bigger, so the value of the stock will fall. As this difference narrows, the denominator will become smaller and the value of the stock will rise. Small changes in KE and G can cause large changes in the stock value, as you can verify from any of the previous examples. If you even change KE or the growth assumption mildly, because there's a lot of compounding happening, that G will get compounded till infinity. So even a small change in G or KE can have a large change in the value. That is why you have to be very careful when you're using the Gordon growth model, because it will be very subject to estimation and modeling bias. Now the dividend will be estimated by the company and industry analysis that we studied in the previous section. The cost of equity will be estimated using the CAPM or a similar method that we studied in portfolio management. The growth rate that the company will achieve will be a function of the reinvestment that the firm has made. So we studied the proof of this in financial reporting and analysis. So there are various ways of estimating the growth. So to estimate the growth rate in dividends, the analyst can use the historical growth rate and assume that as a projection of the future, or he can use the median industry dividend